Hello, and welcome to MIT Sloan Alumni Online. Every month, MIT Sloan Alumni Online brings you the latest breaking news, cutting-edge research, groundbreaking ideas, and school updates from MIT Sloan faculty and alumni. Today, we are pleased to have Tavneet Suri joining us. Tavneet is the Louis E. Saley Professor of Applied Economics and Associate Professor of Applied Economics here at the MIT Sloan School of Management. Her expertise is as a development economist specializing in Sub-Saharan Africa. Her work cuts across multiple sectors related to international development, such as digital financial services for the poor, agriculture, and governance. Over the last decade, she has spent a significant amount of time in the field across Sub-Saharan Africa. She holds a BA in economics from Cambridge University, an MA in International and Development Economics, and a PhD in economics from Yale University. To give our audience a sense of the format for today's session, we'll start with a presentation by Tavneet for about 30 minutes, then follow with a Q&A session. As a reminder to our viewers, you may type in your questions at any time using the Q&A panel in the Zoom interface. So to set the stage for digital finance in Africa, we know that mobile phones are changing life in the developing world with increased access to the internet and basic financial services. So Tavneet, your work with William Jack has looked specifically at M-Pesa in Kenya. And I know you've been trying to answer the question of how mobile money has transformed financial services for low-income people who may not have had access in the past. So how does it work? And what have you seen in your research?
So just to give you a sense of mobile payments or mobile money, this is a map showing it's about a year old now, I guess. Mobile money moves fast, but it's showing kind of the use of mobile money across the developing world. And as you can see, Kenya kind of stands out pretty well on the east side of Africa, where more than half of people have mobile money accounts. In fact, it's closer to probably most people have mobile money accounts, maybe even reaching close to universal. And it's growing in other parts of the developing world, and you can see it's pretty popular in general in Africa. Let me do a bit of kind of quick intro on what mobile money is for those of you who don't know it or haven't seen it used. It's basically a digital wallet on your cell phone, but has the big advantage that it's not backed by a bank account. It's not mobile banking. It's truly a independent digital wallet on your phone that doesn't translate into an individual bank account on the back end. And it also is not, it doesn't need to be a smartphone. So most mobile money systems operate on standard, what we call dumb phones, or very basic, cheap phones. Now, ultimately, with any digital wallet system, you need to be able to cash in and cash out. There are times I will want to put money into my account, and there'll be times I want to take money out of my account. In a banking system, we traditionally go to a bank branch or an ATM to cash out. With mobile money, you're going to cash out at these little stores. You can see a picture of one right there. You know, it's kind of your local corner store, local little kiosk that provides milk, bread, some soda, etc. And they're going to serve as your cash in, cash out points. And one of the biggest things that mobile money figured out how to do was to bring the cash in, cash out points of any financial system much, much closer to consumers and much closer to where people were. So to give you some context, and then I'll show you some numbers, there's about 1,000 ATMs in Kenya as a whole. If you think of these cash in, cash out points for mobile money, they're close to 200,000. So that's about 200 times the infrastructure of the banking system provided by these little kiosks that support the system. Let me try and show you that in numbers and in pictures. So, you know, this is a map of what financial services looked like between 2007 to 2011. And of course, it's imploded since then too. But in the first 4 years, M-Pesa was launched just in 2007. In the first 4 years, you can see this growth in access points. So every dot is an access point for a different type of financial services. The big one, the big growth, of course, you can see is these orange dots that are everywhere. Those are the mobile money agents. Okay, these are people who are providing cash in, cash out on the mobile phone system. If I translate this into some real numbers, oh, sorry, let me just go back. Just so you don't think the top half of this picture looks weird, it's just because population density and economic activity is concentrated where you see the agents. So there's very little population density in the north. Okay, so let me talk a bit about kind of why bringing cash in, cash out points and kind of financial infrastructure right down to consumers really matters. So one of the things that we know in emerging markets is that people tend to have a lot of bad things happen to them. The disease burden is high, there's lots of shocks in weather, there's all sorts of things happening, yet they don't have access to good insurance systems. They tend to be, they can't afford private sector insurance the way we would buy flood insurance or buy health insurance. And the governments tend not to provide a strong social safety net. If you think of the developed world, if I get unemployed, for example, I can get unemployment insurance from the government. So usually in the developed world, what happens when bad events happen to you is I kind of have a social safety net, either from the government or I've purchased private insurance. So what happens in poor countries? In poor countries, I tend to form insurance, sort of informal insurance contracts with my friends and family. So this is what happens. Say my kid gets sick, I'll call a friend and family member who lives somewhere else and say my kid is sick, or send word to them in some way, and they will send some money to me. Okay, so, you know, how do they send it to me? Either they'll jump on a bus and deliver it directly to my house, or they'll give it to a bus driver to send to me. Okay, this is a very standard transaction. You see it all over the developing world, in many, many countries. And, you know, in most countries, it takes the form of me trying to help my friends and family when bad stuff happens to them. And usually that kind of informal deal is returned. So if something bad happens to Greg, I'm going to help him out. And if something bad happens to me, Greg will return the favor. Okay, so you kind of build these informal insurance networks who can help you kind of deal with risk and help you deal with these bad things that happen. And so what mobile money did is, when all these insurance networks require that I can get money to the person who needs it. And so all these transactions were going around the country informally, through the bus networks, through people themselves, through other friends. When mobile money came along, all of this got dumped onto the mobile money system. So instead of me having to get on the bus and deliver money to Greg, I could put it on my phone and then just send it to him via text. So let me show you how the transaction costs changed, and then I'll talk a bit about what mobile money actually did in people's lives. So before mobile money came along, something like a third of Kenyan households lived more than 10 kilometers from a bank branch. The average distance to a bank branch was about 9 kilometers. About 20% of households live more than 20 kilometers from a bank branch. Most people are not driving, so imagine walking 10 kilometers one way to the bank to get money or to deposit money. Right? It's a non-starter for a lot of people. What did M-Pesa do? If you look at our first round of data, which comes from 2008, the average distance a financial transaction traveled was about 200 kilometers. This is almost a $5 bus ride in Kenya. The transaction cost on mobile money is about 35 cents. So you can already see it's going to be much cheaper for me to get money to people in my social network. I'll show you a couple more numbers. The average distance to a bank in 2007, before mobile money launched, was about 9 kilometers. At the time, it was about 5 kilometers to a mobile money agent. And remember, mobile money had just launched then. By 2015, this was down to 1.4 kilometers, and it's now probably down to under a kilometer. Okay, a kilometer is basically a 10-minute walk. So most people are within a 10 to 15-minute walk of a mobile money agent. So they're able to kind of cash in and cash out pretty easy, pretty quickly. And the transaction cost of sending money across space has gone down a lot. Okay, so let me show you exactly what this sort of ability to transact over the phone did for people. So as I described, people are going to use their friends and family as a social network. So what we did over 2008 through 2011 was we kind of tried to document how much this mattered to people. Was there an improvement in their ability to deal with risk, and how much? And the way we do this is we tend to document all the bad things that happened to you. We kind of ask you, did you have any unexpected negative events or negative shocks, as we call them? And then we try to see, did you have to cut your expenses in some way to deal with this? If you're, in the terms of sort of financial inclusion literature, if you're financially resilient, we would see that when something bad happens to you, you kind of don't have to change your expenditure. You don't have to kind of make cuts in your budget. And that's kind of the test for resilience that we think about. So let me show you some results from that, from Kenya. So what I've done here is look at users and non-users of M-Pesa separately, and I'll show you what happens to their expenditures. On the y-axis, I have consumption or expenditures. And so the idea is to understand whether people respond positively or negatively to these bad events in their expenditure patterns. So I'll show you what happened. Let me just draw this out. So basically, when something bad happens, and in this case, it's going to be a very particular bad event, we looked at whether people had someone sick in the household. This is often a child. So imagine your child got sick. So the people who didn't have access to M-Pesa, we kind of look at what happened to their lives. You see that total expenditure went down a tiny, tiny bit, but not much. You see this big increase in medical expenses, okay? And you see them reduce food and non-food, okay? If you look at the users of M-Pesa, their total expenses go up a lot. Their medical expenses go up. So let me talk about medical for a second. Basically what happens is, if someone gets sick in your house, whether it's you or a sibling or a child, you will go find medicine irrespective of whether you have M-Pesa or not, irrespective of whether you're rich or poor. We're seeing this everywhere. Medical expenditures tend to be the priority. If someone's sick, you will go figure out how to get them some medicine of some sort. So you kind of see that both users and non-users will spend on medical care. The difference comes from, okay, where did that money for medicine come from? For the non-users, they have to cut food and non-food to avoid the medicine. Most of the non-food categories, by the way, schooling expenses, so they're cutting education. When you look at the users, what are they doing? They're able to actually spend more on everything. They're spending more on non-food and more on food. And the reason is, we also see in the data, they're able to reach out to their friends and family. They reach out to more people, they're more likely to get help, and they get more help. And so they're able to kind of manage this bad event in a much better way. They're able to compensate not just with medicine, but they'll also provide more food when someone's sick, which is usually what you're supposed to do. So we call this kind of a piece of, we call this financial resilience, and you see this big improvement into resilience because of M-Pesa here, because of mobile money. And it's because it's a more efficient way to reach your networks. It's a more efficient way to reach this network you have that was going to help you when bad things happen. Okay, and it's more efficient because it's very cheap, it's quick, it's safe, and it's very, very easy to use. Okay, so this was kind of up through kind of the first few years that M-Pesa was around, and then we sort of went back a couple of years ago and said, well, you know, if you think that M-Pesa is having these big effects on resilience, then we should expect in the longer term to see more changes. And the reason we would expect this, everybody's heard this notion of higher risk, higher return. If you're better protected on downside risk, we expect people to maybe have made higher risk, higher return investments. Okay, and so we wanted to go back after a while to say, oh, do we see this behavior where people now have better protection for downside risks through this mobile money system and their friends? Do we see them invest differently? And the answer is going to be yes. When we went back in 2016, we basically saw that M-Pesa had reduced poverty by about 2 percentage points in the country. That's about 200,000 households moved out of poverty, you know, just under 1 million people. And then we also saw that about 186,000 women switched their occupation from farming into being a business or retail. And of course, a business, I don't mean a San Fran type startup, you know, it's probably a little kiosk or a stall in the market, okay? But you can see actually people starting to make this transition from farming to business or retail, which we think is higher risk. It's largely women that make that switch, but you do see this higher risk, higher return investment starting to happen. Okay, so that's kind of what M-Pesa has done over the last sort of 7-8 years in Kenya, is kind of enable efficiency gains through a reduction in transaction costs on a bunch of financial transactions. They happened to be sort of what we would call social insurance transactions, but it allowed people to broaden the set of transactions they were doing and also kind of match those to bad events so that they could take advantage of this higher risk, higher return type investments around when they were there. Okay, so for the last few minutes, I'm keeping an eye on time. I wanted to talk about newer work since kind of the mobile money stuff, we kind of wrapped that up about a year ago. Once mobile money started, it's taken off in Kenya, and we're seeing similar things in Uganda and Tanzania. But now that everybody in Kenya pretty much has a mobile money account, there's also been an explosion of something we call digital credit. So what's digital credit? Basically, it's going to be a bank using, I'll come back to this in a second. It's going to be a bank using the rails of mobile money to deliver actual credit products. Okay, so going back to mobile money for a second, mobile money is a product provided by the telecommunications company usually, and it's not truly a bank. You don't get interest on your savings largely. There's a couple of exceptions. You can use it for person-to-person payments, but people are largely not saving on this system. So as mobile money has grown, a bunch of banks have realized that they can layer a digital wallet over mobile money to provide a true bank account for people. Okay, why is this important? So I want to talk about a piece of this that is digital credit and digital loans. So access to credit over a digital bank account. So development economists for a long time have thought about microfinance and the role of microfinance. Okay, and this is work that's done by a bunch of very different academics across the US and other places, thinking about what is the impact of microfinance on people? Does it actually have benefits? And how much is it used? So let me show you the take-up rates. What do I mean by a take-up rate? This is like if I offered a bunch of people loans, of the people eligible for the loan, how many would take it? Okay. And what we've now learned is that the take-up rates of microfinance are actually quite low. So here's 4 examples: Mexico, Peru, South Africa, and Ghana, and you'll see take-up rates from 2% to about 9%. So only between 2 and 9% of people actually want these loans. Accompanying this, we've also seen that the impacts of microfinance are small and focus mostly on consumption. So people have started to think, well, how do we fix this? How do we get credit? Is it just that people don't need credit, or are we not enabling access to credit in a way that works for people? So digital credit is an attempt to kind of make access to credit easier. So let me describe a bit more detail around the product, and then I'll talk you through the slide, which is about the industry in Kenya. So imagine that you have a wallet layered over your mobile money account. You can move money from your mobile money account, which is M-Pesa, into your digital credit account costlessly. If you want to deposit money in your bank account, then you put it into mobile money. You move it from mobile money into the digital bank account, and it's there. If you want to withdraw it, you're going to move it into mobile money and then withdraw through this traditional mobile money system, which is those agents I showed you earlier. So basically, the digital credit or digital bank account is just something digitally layered over mobile money, and it uses the rails of mobile money to do all the cash in, cash out. Why is this good? So first of all, if you're thinking of a digital bank account, I actually don't need bank branches. I don't need tellers. I don't need ATMs. I don't need loan officers. So you can basically now reduce the cost on the supply side of providing a bank account. It's super, super, super cheap for people to provide. The product I'm going to talk about now is this product called M-Shwari, which you can see in this picture. It's bank-led by the Commercial Bank of Africa, and the Commercial Bank of Africa doesn't have a ton of branches in Nairobi. They didn't do a ton of consumer lending, and this was a way for them to reach out to people without having to build branches. Okay, so that's the bank side. Let's talk about the people side. How do I open up a bank account? I literally open it up on my phone. And this doesn't have to be a smartphone. It can be a dumb phone again. And I literally open up the bank account on my phone. I don't need to talk to anybody. I don't need to see anybody. I don't need to go into a bank. it's super, super easy for people to open up this account. When you open up an account on M-Shwari, for example, they use some data on your mobile money transactions and your use of cell phones to give you a credit limit. Okay, and when you look at and then if you have a positive credit limit, you can borrow. And then of course the credit limit evolves over time. If you're saving in the bank and doing other things, your credit limit will evolve. So here's sort of a description of the industry. And there's now about 15 digital lenders in Kenya. The major ones are the 3 bank-led ones. I just mentioned M-Shwari, and then one by Kenya Commercial Bank and one by Equity. And then there's a couple of non-bank-led ones. Tala and Branch are the most sort of well-known, which are smartphone lenders. They're not banks, they're just lending. They're both based in San Fran, and they kind of have raised a bunch of money from investors to do this. And actually, funnily enough, all these lenders provide a monthly loan at between 6 and 12% interest a month. Okay, just to give you a sense of how big the market is, you can see M-Shwari, about 28% of Kenyans have had a loan on M-Shwari. Okay, so that's pretty big relative to the take-up rates I was telling you earlier on microfinance. So one of the big things that digital credit has done is give people access who didn't have access, or give them a loan that people tend to want and want to use. So let me talk a bit about kind of what we did in Kenya in the study, and then I'll show you the results. So we did a study around M-Shwari, given that's the biggest one. And like I said, about 30% of people have a loan on M-Shwari. About 70% of people in Kenya have an account on M-Shwari now. And the advantage of the bank account piece that mobile money wasn't providing is I get interest on my savings and I can borrow. So we wanted to understand, what did the access to credit piece do on M-Shwari? So we ran a study in Kenya, and this is kind of reasonably hot off the presses. The paper's not even out publicly yet, but here's some hot off the presses results. And we're gonna find actually very similar results to kind of what we were finding for mobile money. So aside from take-up being really high, we're gonna find that it improves your access to credit. You have access to more credit, not just in numbers of loans, but in the amount of capital you have access to. So there's a big take-up effect. And we also see it doesn't substitute other forms of credit. So it's not kind of, I take an M-Shwari loan and then I don't get other loans. So it's truly expanding your credit or capital portfolio. So that's kind of one of the big things we're finding, is that it seems to be a very easy way for people to access credit. Lots of people take it, and it's a true increase in the availability of credit for these people. And then we tried to measure out what impacts did this have. So let me show you kind of the big impact. You're basically going to see that the same result as we were finding in mobile money. There's going to be an improvement in resilience. So here I'm showing, did people have to cut meals, cut medical, cut non-food, or use other coping strategies when something bad happened to them? It's very similar to our other mobile money sort of work that I showed you. And we're going to see this improvement in resilience in that people who have access to the M-Shwari loans are less likely to have to cut other parts of their budget to deal with an emergency. When we asked them what the emergencies were, they were largely medical emergencies, again, as we were finding earlier. Okay, one piece of this that's really interesting, when we ask people what they use the loan for, they all say medical expenses, because someone got sick, they got a loan, they went and spent it on medicine. When we looked in the data on where they actually spend it, we don't see it in medical. We see it actually in education. And the reason is, for the people who didn't get the loan, they still went and spent on medicine. Remember what I told you earlier? No matter who you are, if someone's sick, you go find a way to spend on medical care. So basically, for the people who don't have the loan, they'll find a way to spend on medical care. And the way they're doing that, guess what they're cutting to spend on medical? They're going to cut education. And that's exactly what we found in mobile money. When a bad event happens to you, in particular when someone gets sick, a lot of people are giving up education or spending on education to be able to afford the medical, sort of the medication they need. So the two big results we have at M-Shwari was that we see this improvement in resilience. You don't have to cut expenditures when something bad happens. And we also see this improvement in education expenditures. We actually see them more likely to spend on education if they have access to M-Shwari. Okay, I'm going to try and do a couple more minutes before I run out of time. Sorry, Greg. Just because I think one thing that's important to kind of take a bit of a step back and kind of think of what mobile money changes in the world for people. I just thought it'd be fun to put something out there that's ongoing work for us. So I showed you a piece of mobile money that's all, you know, very completed, done, and finished. I showed you this piece on M-Shwari, which is hot off the presses. I'm going to show you something that's in the field right now. And this is with a whole group of people, Banerjee, Michael Fay, Alan Kruger, and Paul Niehaus. And what we're doing is using mobile money to test the idea of a universal basic income. So we have a large randomized controlled trial running in Kenya on a universal basic income. It's truly universal. Everybody in the community gets a basic income. It's about 20,000 people getting a transfer of some sort, and all transfers are delivered on mobile money. So what's key here is without mobile money, we wouldn't have been able to do this. To deliver money to people door to door every week or every 2 weeks or even once a month would be prohibitively expensive. And so mobile money is it's easy to access, everybody has an account, and the transaction costs are so low that you can now start to do things like think about a universal basic income. So let me tell you a bit about the study, and then I'll kind of wrap up. We don't have any results yet. The first follow-up survey will happen in spring 2019, so very soon. So what do? We took about 295 villages in Kenya. It's about 30,000 people, and randomly assigned them to one of 4 groups. We have a control group where they don't receive any payments. A group that has a long-term universal basic income, they're getting 75 cents an adult a day for 12 years. A short-term universal basic income where they get the same amount but for 2 years. And a lump sum where they get the equivalent of the 2-year transfers, but they get it in lump sum per adult. And the idea is not just to think about whether a universal basic income can help poor people move out of poverty, but also kind of what should the right structure of a universal basic income be. So this has now been in the field. We finished our baseline about well over a year ago, and transfers have been going out for 4 or 5 months now. And so we'll start to track kind of what impacts this UBI has on people's ability to take risk, to invest in their kids, their assets, their wealth, and a whole host of other outcomes. So please stay tuned. Hopefully in a year, we'll be able to tell you some of the first results on this study. Okay, let me take stock and wrap up and then try and take some questions. So what has all this work sort of resulted in? Look, what's the big thing we've learned? I think the big thing we've learned is that resilience to economic shocks is absolutely crucial in developing countries. You know, if you think of our Kenya case, about half of households report an economic shock of this sort. And we've been replicating some of these surveys in a bunch of developing countries, and this is true in many, many developing countries. The number's always between 40 and 55% of people reporting this. So clearly, economic shocks are a big part of people's lives, and because social safety nets from the government and private sector aren't quite there, how to deal with these becomes an important part of their lives. And what do we find? Digital products, whether it's mobile money or digital credit, tend to improve resilience. They give you an opportunity to manage these bad economic shocks better, okay? In mobile money, it's because you're able to grow your informal insurance network and engage with them better. With digital credit, it's just a little bit of extra money that you could take on loan to help you manage this economic shock. So I think largely digital products have been really useful in that component of people's lives in emerging markets. But I will stop with a caution that product diversity is really key. If you think that there's 15 digital lenders now in Kenya, they all offer the same product. It's a loan for a month, right? You know, it might be that economic shocks are big enough that a monthly loan is not enough to get you over that shock. And so I think there's a ton of room to think about how to tailor products, how to provide consumers with more product diversity and get even more gains from these products. Okay, I'll stop there. Thank you so much. And I look forward to some questions. Greg, should I hand back to you?
Yep, sounds great. Thank you,
Awesome.
Tavneet. And the universal basic income piece is so fascinating. I feel like in the US, it tends to be such a philosophical debate of should we or shouldn't we, but really great to hear about your ongoing work and really.
Yeah, just on that, Greg, like it's the number of, podcast questions, debates on this is huge. I think our take tends to be, everybody has an opinion. Some people say you'll stop working because you now have a bit of money and it's there. There's no evidence. And so we can have all the discussions we want. All of our opinions are based on some gut feel, but there's no evidence. So that's why we started the study, is we felt like there was this huge discussion going on, but yet no actual evidence on whether it does any of the things that we think it might, good or bad. So hopefully in a year, we'll be able to tell you that.
Excellent. Well, we look forward to hearing more. So as we move into the Q&A session, I just want to remind our viewers, you may type your questions into the Q&A panel. And while you're doing that, I'll just do a quick announcements here on some upcoming events. So on December 4th, we will have another MIT Sloan Alumni online presentation from Bryn Panay Burkhart. She's our Senior Associate Director of Alumni Career Services, and she'll be speaking about salary negotiation. And then on December 8th, we will be doing a live stream of the MIT Sloan Retail and Consumer Goods Conference. So you can register for both of those events on our website, and we hope you'll be able to attend. And so now we'll move into the Q&A for Tavneet. So our first question, so you've covered a lot of ground, and thank you again for sharing your work in these different areas. But one of the questions that came in is, are some of the issues that you're grappling with largely political as opposed to economic issues? And so maybe what kind of policy changes do you think can have the greatest impact for folks in Sub-Saharan Africa?
Tough question, Greg. Whoever sent that question, thank you very much for putting me on the spot. Look, I think politics is definitely an important constraint. It's just we can't not do anything because politics takes over. Let me do a pitch for the Poverty Action Lab at MIT. If any of you don't know it, please look up the Poverty Action Lab at MIT. We've been doing a bunch of work under a governance initiative around how to improve governance and how to improve political participation in systems. So I think my answer to this would be we need a lot more evidence on all the sorts of things that work before we're saying politics is or isn't the biggest constraint. I do think it's an important issue and an important set of issues. But I also think, you can't not do stuff because the politics sometimes takes over. And actually the mobile money work has sort of shown that there is an ability for things produced actually by the private sector, right? This is all telcos and banks, to really have an effect on poor people's lives if it's well thought through, well designed, well implemented. And so I think there's room to do things, especially within the private sector, that could be transformational in people's lives.
Great, thank you. Another question that we've had is, you touched on this a little bit, but how is the role of banks changing with the huge adoption of mobile payment technology? So you mentioned kind of banks increasing access, almost a digital wallet, or expanding access to credit. What else do you see in that space?
Yeah, so initially, funnily enough, of course, banks hated mobile money because they felt like it was competing with them. I remember when we did our first round of surveys, this is like 10 years ago. God, I feel old. The banks were really complaining. And actually the central bank then should have, in Kenya, announced an audit of the system, and then sort of also announced that there was an MIT prof doing a study on fraud in the system. And I was like, we are? Okay. So the banks were really upset. It turns out that they kind of didn't realize how popular it would be. And it was already really popular by the time it registered on their radar or whatever. And by the time they complained, people really liked it. There was no evidence of fraud or anything. And so it was like really hard to shut down. So I think what the banks decided was, well, if you can't beat them, you join them. So the banks are actually all large. I think almost all of them started providing mobile money agent services. So you saw the with cash in, cash out, they all provided cash in, cash out at their branches. And then these digital bank accounts are all collaborations with banks, right? Because you're not allowed to take deposits unless you're a bank. And so they've decided to try and collaborate with the telcos to provide banking services, because they realize the telco is not going to give credit. They're not a bank. They're not trying to assess risk. They're not trying to understand banking systems, right? They want cell phones to be used for everything, and they want a piece of that pie, but they don't really want to be a bank. And so I think the banks have decided we can't beat them, so why don't we join them and try to grow the set of financial services that people have access to on their mobile phones.
Great, thank you. And one of the questions that have come in from our audience, it seems that in Kenya, there's been a much higher adoption of mobile money technologies. So first, is that true based on your research? And maybe why is that as opposed to other countries in Africa?
Yeah, good question. So two things. One, it is true right now. I will say this, Kenya launched before a lot of countries, so they're ahead also because these things take time. So that's one small piece of it. I think a piece of it was business model of the telco. The first use of this service is kind of a person-to-person transaction that's across space. If I'm charging you a transaction fee and I'm standing next to you, I'm going to give it to you in cash and not on mobile money, right? Why would I pay any fee? So if you want that to be kind of the main use of the service to start you off, I need those agents, those cash in, cash out points everywhere. So when M-Pesa started in Kenya, they had 4,500, if my memory is right, agents across the country. That was already 4 times the banking infrastructure, right as they started. And this is not 5 years later. This is at the start point. And it was because they knew people are going to use it for transactions across space. So I need cash in, cash out points everywhere. So I think it's taken some other telcos a bit of time to work out that business model. So I think that's a piece of it. I should say Tanzania is growing really fast. Uganda is growing really fast. Those are probably above 50% now, is my guess, in the number of people who have accounts. So, and then the M-Shwari that I talked about, the digital credit product, the Commercial Bank of Africa has launched it in Tanzania, and it's doing pretty well there. It's not, of course, as popular as in Kenya, but it was because it was launched 3 years later or something. It's in Uganda, it's in Rwanda. I think they have plans to launch in Cote d'Ivoire as well. So, I think some of it is just a matter of time, and some of it is the telcos need to work out the business model and figure it out. And then there's some countries where it just largely is non-existent because the government regulation won't allow it. So if you see places that just have none, it's likely to be a regulation issue. If you see a little, but it's not growing too much, that's usually a business model issue. And then if it's growing, it's because they're on their way and they'll catch up.
Thank you. And certainly with the rapid rise in adoption of this technology, it makes you wonder a little bit about cybersecurity. So yeah. It seems, that's a huge concern in the US and the Western world. It seems every other day or week we hear of another breach of data. How does this concern materialize in Kenya or in the other countries that you're working in?
Yeah. So there's one advantage to having non-smartphones. So the big advantage is all of this is largely on non-smartphones. Now it'll move to smartphones at some point. You can get a $40 smartphone in Kenya right now. It's not Apple, don't worry. But so I think that's one advantage, is it's not smartphones. So you're gonna get, it's much harder to get into these phones, right? That's one. The second is most mobile money regulators have regulated the transaction size because they're worried about anti-money laundering regulations, things like this. So the transaction sizes are small, they're not huge. This is meant to be a product for people in the lower bottom end of the spectrum, income-wise. It's not meant to be for rich people who want to transfer thousands of dollars, right? So given that, if you think of, how much money is in someone's mobile wallet, it's not going to be tons and tons of money. It's going to be very small amounts. And so I think the hacking thing or the cybersecurity thing, it just becomes really hard because, both crime and sort of trying to get into someone's phone will only give you a couple of dollars per phone. So now I need to get into millions of phones for this to make any sense for me. And that's pretty hard to do on these old phones. If you thought of, you'd much rather hack into a banking system entirely, or, if you wanted to hold someone up, you'd rather hold someone up and drive them to the ATM and have them empty out their ATM, right? So I think the advantage in some sense is that the transaction sizes are very small, the amount in your accounts are small, and it's all on these sort of dumb phones. Now, of course, like I said, as it gets to smartphones, this will become a bigger issue. All the money is not actually stored on your phone, right? So it is sitting somewhat protected. So in that sense, I guess, as long as there is some version of FDIC, there's a bit of protection there if it's a bank account. I think the other piece is, I wanted to say this. Every time you do a transaction on your phone, you have to enter a PIN. So think of your debit card. It's a bit like your debit card. You need to know the PIN. So, putting a little sticker on your phone with what your PIN number is not a good idea. Don't do that. But there is PIN protection. So it's not just I get your phone and I get everything. I still need to know something about your PIN number. So there is a bunch of security in the system. And then one other thing worth mentioning is when it's not on a smartphone, everything works off SMS, but the SMS never contains your PIN number. It just says, Tavneet sent Greg $5. So you can't even kind of collect up text messages and find something from them.
Right.
So I think on the old phone system, it's really, really hard to get in and hack. It's really hard to steal. It's really hard to do all these things because it's just too small amounts for the work required. Now, as we go to smartphones, this is going to become easier and easier, especially as we start to do over the top kind of transactions and stuff like that. Then I think it will become easier. Aside from, so there's a piece that's cybersecurity. So I'm hoping all of our banks are getting good cybersecurity people. And the other piece is the data protection piece. And that's trickier because we still have yet to have a conversation in Kenya about who owns the data, right? And who has what rights over the data. I mean, these are still conversations being had in the West, let alone in a developing country. But certainly, there's now a lot of discussion around data protection and data privacy laws and whether we need those given, how far ahead we are on this digital landscape in emerging markets.
Right.
So I think that's all to come, and important.
Changing rapidly, so thank you for that. Switching gears a little bit, so thinking about your work, and you mentioned that often this is folks that are lower income or would be considered such. How can some of this be applied to the United States and maybe some of our own kind of lower income communities?
Yeah, good question. When we first started working on this, the payments group of the Fed sits at the Boston Fed, and so they came and sat with us saying, we think this would be a good way to reach the unbanked in the US, because there are people who don't have accounts in the US. It turns out, the US has a lot of banking regulation, quite a lot. And so described kind of how mobile money works. They were like, can't do that, it hits this regulation. Can't do that, it hits this regulation. So I think it would be impossible to implement the way it works in emerging markets here because this is a pretty regulated environment. And so it's really hard to build the regulation needed to do this. I think that's one of the advantages of emerging markets is they haven't really built a ton of financial regulation because they don't do that much in financial transaction space. And so it gave them an opportunity to build the regulation they needed around the system. So I think it's really hard to just import the technology across. I think this idea that, two things. One, that poor people need financial services in some way, and they can be designed to be beneficial to them is, I think, definitely true, right? That seems like a notion that carries across. And I think, second, thinking about how to reach people who are unbanked in creative ways is important as well. I mean, it has happened a little in the US. So something that happened a while ago was kind of these prepaid MasterCards and Visa cards. That, I think, has been a start of a way to reach people unbanked. You can kind of deposit salary onto this prepaid MasterCard, so it doesn't have to have a bank account on the back end. But I think there's got to be better ways to do this. I mean, Venmo is close to this in the sense that it is person-to-person transfers, but it has bank accounts still on the back. So I think there is room to innovate about how to reach that segment of the population here.
Great, thank you. I want to stick with an idea of kind of social impact. What are the opportunities for entrepreneurs, to create socially responsible but profitable ventures in Africa? I think
plenty. I teach an entire class on this, Greg.
Excellent.
So if there's non-alums, but people who are thinking about coming to Sloan, come to Sloan and hang out with us. So Greg, long question, could spend days on this, but yes, I think there's lots of opportunities. I mean, I think one of the things that I try to say is that, we think of emerging markets as having a lot of what we call market failures. Markets don't work. They don't work very well. Transaction costs are very high. So I think sometimes, like if you think of the telco that built mobile money, I don't think they had any sense that it would have the social impact it had, right? I think the person who was running the telco thought it might, but they didn't do it kind of with that motivation in mind. They did it to make some money, right? They did it to make profit, and it makes them profit, right? It took a few years to turn a profit, but it's making them plenty, right? So I think it was a win-win, right? They're making money, but they're also doing something that has had impact on people's lives. So I do think there's lots of opportunities for this. And it's because markets are so inefficient that when you make a market slightly more efficient, there's sort of, in essence, an arbitrage opportunity, which allows you to make profit. But because the market was so inefficient, people weren't engaging in the market. And when you create efficiency, you'll bring people into the market. And so that's going to have an impact on their lives. And so I think, these win-wins are, I think, much easier in emerging markets because you can find many situations where you're solving a market inefficiency or, completing a market or and those are the sorts of places where it becomes win-win. You're going to improve people's access to some market, and at the same time, you'll make money because there's some sort of arbitrage opportunity. And that's basically what mobile money did. And I think thinking of it that way allows you to see that these opportunities are plenty.
Great, thank you. So I think we'll take one more question just to close us out here. What are you seeing right now that is really exciting for you, either in Kenya or in other countries that you're working with? Like, what really lights the spark and gets you excited?
Oh, you have to end with a hard question, Greg. What am I excited about? So actually, I'm excited about two things. I can mention both. One is kind of the internet is starting to pick up in this part of the world quite dramatically, and smartphones are becoming really, really, really cheap. So I think getting people access to the internet could be a big next kind of step. There's already a bit of work showing that access to the internet in some cities has improved employment opportunities for people. And so I think trying to really think about how we get cheap, quick, easy access to the internet to people will be is one of the things I'm excited about. And I say that because we have a study running on this with our survey ongoing right now. So I think that piece is interesting. And then with smartphones, you're going to be able to grow the set of, products, all sorts of, I want to say products, but, services and products that people have access to. So if you think of credit, I can do all sorts of different types of credit and insurance and savings and a bunch of things that are hard to do on a non-smartphone because you can't tailor as much, you can't do all sorts of stuff. I think the data piece is also going to be really exciting. There's a lot of data that telcos and banks have. Now, of course, very tricky, because as I talked about, data privacy and ownership issues will come up. But if we can be sensible about how we regulate those, I think the data piece will be super important, super, super important. These are places where there is no data. And suddenly you're seeing volumes of data appear because people are being brought into these systems in a massive way. That can go both ways, Greg, but I think there's an opportunity to do good there in a big way. Yeah.
Excellent. Well, Tavneet, thank you so much for being with us today. I want to thank all of our Sloan alumni and friends for joining us as well. To keep this conversation going over social media, please use the hashtag SloanieChat. Following this event, you will receive a survey via email as well as a link to the recording. So please fill that out and let us know your feedback on this session, as well as our ongoing lineup of events for the fall. As always, you can reach out to us at sloanalumnionline@mit.edu. And thanks for joining us today. And Tavneet, thank you again for your time. We really appreciate it and really great to hear all about your work. So thank you.
Anytime, Greg. Thanks for hosting and thank you all for joining us. Come say hi if you're at Sloan.